Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Eric, there's a lot of confusion over annuitize, annuitization, or income riders.
Yeah, you hear the term. We even hear some people call it annuicide, but and that is a common misconception because with every annuity, thus the term, you have the option for annuitization.
Yes.
So everybody, when they think about taking lifetime income, you start talking about annuitization, right?
Right. Well,
but we've got a little new trick,
a little twist.
Yeah, it's all of a sudden now we've got these income riders that provide for lifetime income without annuitization. But
Right.
for most people, their level of thinking is, I'm turning on the lifetime income aspect.
I'm going to annuitize. That's what they say. Yeah. And going back on income riders a little bit, the variable annuity was the first kind of groundbreaker with the income rider.
Yeah, they were the first one to really offer an income rider,
Right,
giving the lifetime income.
Yeah, called living benefits and income riders, and it kind of dominated the scenery, on that for quite a while, or the scene, and became very popular. That we went through the financial crisis, back in 08, 09. And the indexed annuity then kind of moved to the forefront, and the variable annuity kind of dropped back in terms of what it could contractually guarantee.
Well, yeah,
for income.
And the simple explanation is, unfortunately, when those account balances on those variable annuities dropped so significantly,
yes,
the insurance company all of a sudden figured out they're on the hook for a lot more benefits than what the account balances had.
Right.
So their liability was a lot greater with those than if you use those same benefits or better benefits on a fixed annuity with no chances of loss of principal.
Right, because their money is put away in long-term treasuries and investment-grade bonds, this type of thing. So it was pretty big rude awakening, back in 08, when the insurance companies, a lot of them have bailed out since then.
Right, and yes, there's a considerable number of variable annuity companies that said, I went out of the business, too much liability.
Yeah.
So thus you're seeing kind of the rise of all these income riders becoming available on indexed annuities.
Yes, and it is interesting that a few of the straight fixed annuities will offer an income rider, but it's really been predominantly on the fixed indexed annuities where you've got that ability to capture so at least a portion of that market upside, but these contractual guarantees that allow you to maintain control over your account value. And still have lifetime income.
Yeah, so you're getting the that rider aspect, and so we get to the point where all right, I'm going to start taking income. The question is now, do I use the income rider or do I annuitize? And some people don't realize that they actually have that choice at the time where they start to turn on income.
Right.
So why would we pick annuitization when we have an income rider, Dick?
Well, and that's a very good question, Eric. And everyone needs to understand that typically annuitization will pay more in the early years than the income rider will. However, the income rider, when you get into the later years, typically will pay more. And there's all kinds of little, caveats to that. So if you don't run the numbers, you just don't know.
Right.
Eric, one of the caveats that we also have to point out that's been very popular are the roll-up rates when the annuity is in deferral. So
right, and then that's what a lot of people see advertised out there. As we always say, that's the sizzle with these pieces. You see the 7% guaranteed roll up while it's in deferral,
and it's very real if you're using it for income to get that 7-8% that is guaranteed growth, contractual growth, and this is where it can really beat the annuitization aspect, and that's why we talk in terms of when you go further out. The income rider starts to overcome the annuitization. But in the early years, before it's had that chance to grow and roll up as much, you just don't have that same advantage.
Right. It's always nice to get the aspect of get some guaranteed growth while it's in deferral. And this is where we talk about what is annuitization again. You're giving up control of your asset. And that's why people really do like these income riders.
Right.
Because it's about control of your money. Who do you want to control it? Would you rather have a bigger slice of allowance from your parents, the insurance company here?
Yeah.
Or would you rather have control of all the asset, in basically, or majority control?
Right.
And be able to basically take a little bit less money is really what the choice a lot of times comes down to for folks.
Well, and in retirement, cash flow becomes king.
Yes.
It's not so much the return on your money, but the return of your money, and a greater return of your money, which does equate into an internal rate of return or a growth on your money.
Right.
And so, again, these are just mathematical equations that have to be run so that you can know, which one is the best choice. And many folks do like the idea of that cake and eat it too, where they get to control their account value. In the early years, we call it majority control because of the surrender fees. After, say, the first 10 years, thereabouts, you have complete control. So you have 100% control of all of the money in the account that you have not spent or taken in a lifetime income.
Right. And so now, when you're first starting out, you're sitting down, you're deciding an annuity is right for you, you decide you're going to elect an income rider.
Yes.
There's a choice sometimes you have to make with certain companies. There is, if you're a married individual, some of these companies have you choose up front, are you going to select for single lifetime income on your income rider or joint lifetime income? And I really be honest, I don't like it when you have to choose up front.
Well, I don't either, Eric. And, there's a few companies out there that actually do force that issue up front because we never know. 5-10 years down the line, if we're going to need joint or single.
Yeah.
Obviously, we hope that we're living. We hope that we're still married.
Or hope the spouse is still there. Yeah, exactly.
There's all of these variables that could potentially take place. And if I choose up front that I'm going to go with the joint payout, and I have to choose that up front, that usually cuts me back by about 0.5% in payout amount over maybe 30 years.
Yeah.
That's thousands and thousands of dollars I would potentially lose by picking the wrong option, where other companies allow me to choose that joint or single 5, 10, 15 years later when it's time to turn the lifetime income on.
Right. And so those choices are obviously key because you're usually you're usually paying a rider fee for that selection of that lifetime income rider.
Right.
So, and this is one of the things and why it was kind of important for us to talk about this today is if you get to that point, you've elected joint income initially, you get to the income rider statement, all
and
of
you
a
don't
sudden,
need a joint.
You don't need a joint. You
single.
need more income. You're single.
Take a look at annuitization. That's right.
So you're not necessarily still tied in because you can annuitize the cash account value there at that point in time.
Yes. So Eric, really, what should people be thinking of in terms of choosing between the income rider, which sometimes you have to pay for it? There are free ones now.
Yes.
So choosing between the income rider and annuitizing, which should they choose?
Well, I think the opportune answer is to say I don't have to choose until that time comes where I need income, and that's the point where you look at it, you run the numbers, and you say, hey, what's best for me?
I agree.